Right now, the U.S. economy is acting like this runaway freight train, right? But then you look at Bitcoin and it just completely fell off the cliff down to $65,000.
Yeah, it really did.
And today is June 3rd, 2026. And I got to say, the foundational rules of, market gravity, they just appear to be completely broken.
Absolutely.
Because normally when the broader economy is running this hot, risk assets are just flying high right alongside it. But today we were looking at this massive structural disconnect.
It's a profound divergence. I mean, we have a domestic economy that is just defying all conventional historical models.
Right.
And that's sitting in stark contrast to a really aggressive cryptocurrency sell-off. So for anyone managing capital or, even if you're just watching your retirement portfolio, the current landscape is creating some severe cognitive dissonance.
Which is exactly why we're dedicating today's deep dive into the source material to just figuring out what is actually happening beneath the surface. And we have an incredible stack of sources today for you.
We really do.
We've got a comprehensive crypto market report, and we're looking at that alongside some really deep macroeconomic and technical analysis from market strategist Benjamin Cowan, as well as the team over at Forward Guidance, so Felix and David Cervantes.
And our mission today is to step entirely away from the daily price tickers. We really need to isolate the massive hidden crosscurrents that are moving global capital right now.
Right, getting past the noise.
Exactly. By analyzing these sources, we want to give you a clear mechanistic framework, to decode whether this crypto pullback is just a localized market flush or if it's actually the leading edge of a fundamental shift in the global economy.
Okay, so let's unpack this, starting with the immediate damage. Because Bitcoin hitting 65,000, that didn't just happen because of one bad headline.
No, not at all.
According to the Crypto Market Report, there are basically 5 compounding forces hitting the assets simultaneously. It's like a Jenga tower where someone pulled 5 blocks out at the exact same time.
That is a great way to put it.
Right. So first, we just saw $500 million in ETF outflows.
Yeah, massive.
And then, we have these flaring tensions in the Middle East driving up oil prices, which naturally tightens risk appetite across the board.
Right.
Then you have Matt Hugan, the CIO at Bitwise. He's actually calling crypto a contrarian bet now, as these momentum traders just actively rotate their capital away.
And don't forget the liquidations.
Right, the liquidations. $1.5 billion in long liquidations in a single 24-hour period. I mean, that is essentially an avalanche.
It really is. Once the price drops to a certain level, forced selling triggers more forced selling, the algorithms take over, and leverage just gets violently wiped out.
Yeah.
And the speed of that liquidation cascade, it just shows how fragile the market structure had actually become.
Because everyone was just assuming the price would keep going up.
Exactly. Traders were heavily over-leveraged. But, the fifth force you mentioned from the report, the overhang of the Saylor selling, that is arguably doing the most psychological damage right now.
Okay, let's unpack the mechanics of that one too. Because Michael Saylor and MicroStrategy, they are fundamentally viewed as the ultimate Bitcoin accumulators, right?
Right, the ultimate bulls.
Yeah, they're basically the proxy for unshakable corporate conviction. So if there's even a whisper or like a structural movement that suggests taking chips off the table from that specific camp, it totally spooks the entire herd.
Well, what's fascinating here is how quickly the narrative shifted. It just completely shatters the illusion of perpetual buying pressure.
Oh, totally.
When the market's loudest bull is perceived to be distributing assets or even just adjusting their treasury strategy, retail investors panic.
Of course they do.
Because capital always flows to where it feels safest and most rewarded. So when you combine that geopolitical risk in the Middle East with a sudden lack of conviction from your major institutional proxies, well, momentum traders don't just pause. They actively pull their capital out of the ecosystem.
Right. But that leads me to my pushback here. Is this just a natural flush of over-leveraged traders, or are we seeing a genuine loss of institutional faith? And if these institutional momentum traders are ripping their capital out of a volatile asset like crypto, they have to park that money somewhere, right?
They do.
And historically, they retreat to cash or treasury bonds. But when you look at the macroeconomic data from Forward Guidance, that is not what's happening.
Not at all.
They're pouring it directly into big tech.
Yeah.
I mean, it feels like the U.S. economy is a card that should be completely out of gas by now, but big tech and the government just keep throwing rocket fuel into the tank.
That's exactly what's happening. For the last 2 years, economists have been predicting this severe recession, and they have been consistently wrong.
Consistently.
Because they completely underestimated the sheer overwhelming volume of capital being unleashed by those two specific sectors.
The numbers are, honestly, they're almost difficult to process. I mean, big tech companies are currently spending $1 trillion building out artificial intelligence infrastructure.
$1 trillion. It's staggering.
Yeah. Google alone just raised $80 billion in new shares, purely to fund their AI expansion.
Yeah.
And that $80 billion, it isn't just sitting dormant in a Silicon Valley bank account.
No, it's out in the world.
Right. It's paying for thousands of tons of steel, liquid cooling systems, specialized microchips, real estate, engineering salaries. It is this massive economic multiplier.
The velocity of that money moving through the economy is just wild. And, it's operating alongside an equally massive secondary engine, which is the U.S. government.
Right.
They are currently running a deficit of 6 to 7% of gross domestic product.
Which is crazy.
It is. To run a deficit that large when the country is not actively in a severe recession or like a global war, that is historically unprecedented.
So let's break down how that actually impacts the economy on a functional level. Because usually when people hear government deficit, it sounds like a bad thing for the country's balance sheet, right?
Right, it sounds negative. But think of the macroeconomy as a closed accounting ledger. When the public sector, the government spends roughly 7% more than it extracts in taxes, that capital doesn't simply vanish.
It has to go somewhere.
Exactly. It lands directly as a net surplus on the private sector's balance sheet.
Oh, I see.
So every dollar borrowed and spent by the Treasury is a dollar injected into defense contractors, infrastructure projects, and ultimately consumer bank accounts. It acts as this continuous structural injection of liquidity.
But, I mean, the average consumer isn't building data centers or landing federal defense contracts.
Sure.
Yet, they're still spending aggressively. And the sources actually highlight a few specific safety nets keeping everyday people afloat right now.
Yeah, there are a few key buffers.
Like, we're seeing this massive wealth transfer where boomer parents are basically quietly funding their adult children's living expenses.
Yes.
Plus, you have millions of homeowners sitting on sub 3% mortgages, or they've paid off their homes entirely, so they're completely insulated from current housing costs.
Which frees up a lot of cash.
Exactly. And then you have the broader wealth effect.
Right. The wealth effect is a crucial psychological buffer.
How so?
Well, when everyday investors look at their retirement accounts and see that their portfolios are up, say, 40% because of this massive AI tech boom, their behavior changes.
You feel rich.
They feel insulated, so they book expensive vacations, they buy new cars, and they absorb higher prices without pulling back on consumption.
Wow.
The sheer mass of this AI spending and the government deficit, it's just absorbing all the available capital in the market. Capital that, in a totally different environment, might have flowed into speculative assets like crypto.
Okay, but rocket fuel burns incredibly hot, right? That kind of relentless economic velocity comes with an exhaust pipe. And right now, it is blowing dark smoke.
Definitely is.
Because according to the data, inflation was steadily climbing even before these recent geopolitical tensions in the Middle East really escalated. Now, the bond markets are actively beginning to price in unexpected interest rate hikes.
Because inflation is the ultimate kryptonite to this current economic expansion. I mean, if prices run too hot, the Federal Reserve is forced to raise the cost of borrowing,
right,
which then chokes off the capital supply that's funding all of this growth in the first place.
Which brings us to this incredibly bizarre development mentioned in the forward guidance summary.
Oh, the inflation metric.
Yes. The new Fed chair, Kevin Warsh, is actively trying to change the metric used to measure inflation. So the proposal would artificially drop the reported inflation number from 3.3% down to 2.5% simply by altering the calculation methodology.
Yeah.
But here's where it gets really interesting. Changing the math doesn't lower the actual price of a gallon of milk or a tank of gas.
No, it doesn't.
So how does the Fed expect Wall Street to just play along with a manipulated number? I mean, if the Fed is just changing the ruler they use to measure inflation, doesn't that mean we're flying blind? You can't just spreadsheet away real-world costs.
You can't.
Yeah.
And that is exactly why other Fed officials are pushing back so aggressively against Warsh's proposal.
I would imagine.
Changing the metric is a glaring symptom of institutional anxiety. It's purely an optics management strategy at this point.
They're trying to make the number look prettier.
Exactly. The Federal Reserve knows they cannot control the underlying prices right now, so they are attempting to manage the psychological reaction to those prices. They're trying to buy time because they see a massive, unavoidable supply shock right on the immediate horizon.
The emergency oil reserve.
Correct. Connecting it back to the bigger picture, the forward guidance analysis highlights a critical physical ticking clock.
Right.
For months now, both the United States and China have been aggressively draining their strategic petroleum reserves. They've been dumping millions of barrels of emergency oil into the open market to basically artificially increase global supply.
And suppress energy prices.
Exactly.
But those reserves are finite,
And
and you can't drain a tank forever.
No.
According to the projections in the data, those emergency reserves hit effectively empty around late July of this year.
once those reserves are depleted, that artificial downward pressure on global energy prices instantly vanishes.
Yeah.
If Middle East tensions continue to restrict natural oil production at the exact moment those emergency reserves run dry, the market is going to experience a severe supply shock.
And energy dictates everything.
Everything, shipping, manufacturing, agriculture. It would trigger a fresh, undeniable wave of inflation that could force the Fed into emergency rate hikes. And that is a scenario the market has entirely failed to price in.
So with a potential macroeconomic earthquake looming in July, you would think the cryptocurrency industry would be hunkering down defensively, right?
I think so.
But instead, according to the Crypto Market Report, they are aggressively rewriting their entire regulatory playbook. They've completely abandoned the old libertarian, keep the government out of our code narrative.
Yeah, that ideological shift is born out of pure pragmatism. I think the industry has realized that securing long-term institutional capital requires total integration with the traditional financial surveillance apparatus.
And they're executing that pivot with incredible tactical precision. I mean, the Blockchain Association just totally bypassed the usual tech lobbyist route.
Yeah.
They gathered 160 former national security and law enforcement officials, and they sent their signatures directly to Senate leadership to push for the Clarity Act.
It's a huge move.
They aren't saying crypto is good, regulation is bad anymore. They are sending in ex-cops to say, regulate us strictly so we can hunt down illicit finance.
This raises an important question, though, about the mechanics of the Clarity Act because they are intentionally stringent.
Very.
It proposes a massive expansion of the Bank Secrecy Act to cover decentralized protocols. It mandates formal real-time intelligence sharing between the Treasury Department and private blockchain analytics firms. And furthermore, it actually establishes a permanent specialized task force dedicated exclusively to crypto-related financial crime.
So they are volunteering for heavy federal surveillance.
Exactly, in exchange for legal legitimization.
But Washington is a complex machine, and the Clarity Act is facing some severe legislative roadblocks right now.
It is.
Just to look at the facts objectively here, there are intense debates completely stalling any progress. On one side, you have Senator Sanders and Warren, along with Representative Bobby Scott, and they are actively pushing the Department of Labor to block 401k retirement plans from offering crypto investments.
Right.
And their legislative argument centers entirely on consumer protection. They're pointing to projections of $11 billion in crypto fraud losses for 2025.
And running parallel to that consumer protection debate is a fierce legislative fight over ethics provisions.
Yeah, the ethics clauses.
There is a strong push to attach rules to the Clarity Act that would permanently ban elected officials from personally participating in or profiting from crypto ventures.
Which is a huge sticking point.
It is. And given President Trump's background business conflicts regarding his own crypto ventures, this ethics provision has become heavily politicized. It's basically grinding the legislative gears to an absolute halt.
Right.
So putting the merits of either side's arguments aside, those are just the concrete realities that are paralyzing federal action right now.
But here is the fascinating dichotomy. While lawmakers are arguing over ethics clauses and retirement funds, Wall Street is not waiting for permission.
No, they are not.
They are quietly laying down permanent institutional-grade plumbing. We aren't just talking about companies buying Bitcoin to hold on a balance sheet anymore. We are watching a complete structural shift toward tokenization.
The infrastructure developments highlighted in the report, they really represent a fundamental merging of traditional finance and blockchain technology.
Just look at the sheer scale of the partnerships. Coinbase is integrating with Athena to expand their on-chain products to over 100 million users.
That's huge.
It is. Athena essentially creates this synthetic crypto-native dollar that generates high yields. And now it's being plugged directly into the largest exchange platform in the US.
Yeah.
Then you have legacy titans like Franklin Templeton bringing BNG, which is their tokenized money market fund, onto the MoonPay platform.
And putting a traditional money market fund onto a blockchain, that is a massive functional upgrade for institutional capital.
How does that actually change things for them?
Well, it means clients can move millions of dollars, earn treasury-backed yield, and settle transactions 24 hours a day, 7 days a week.
No weekends off.
Exactly.
Yeah.
They entirely bypass traditional working hours and clearinghouse delays.
And the momentum is just accelerating across the board. Strive Asset Management just purchased 2,500 Bitcoin for their corporate treasury, basically treating it as a standard reserve asset. Galaxy Digital launched a $10 million over-the-counter prediction market desk. So this allows major institutions to place these massive, customized bets on future events without routing the trades through public exchanges.
Wall Street is building a parallel financial system while Washington is still arguing over the blueprints.
Exactly.
It really demonstrates a high conviction bet from traditional finance. They are investing hundreds of millions of dollars into engineering and compliance infrastructure. They are planning for a decades-long integration of this asset class, completely regardless of the short-term political friction or the daily price volatility.
Okay, so we have a staggering amount of data on the board right now.
We really do.
We have artificial intelligence development sucking up $1 trillion and keeping the economy running hot.
Yeah.
We have a manipulated inflation metric masking an impending oil supply shock in late July. We have gridlock in Washington while Wall Street wires up tokenized money market funds.
It's a lot to process.
It is. So what does this actually mean for Bitcoin's price timeline? How on earth do you map it onto that level of global chaos?
Well, to find the signal in all that noise, we have to rely on historical data and market mechanics. And this is where Benjamin Cowen's cycle analysis provides a vital framework.
Okay.
Because despite all these unprecedented macroeconomic variables, the underlying human psychology that drives market cycles, that rotation from greed to over-leverage to capitulation to consolidation, it tends to repeat with almost mathematical precision.
So Cowen's analysis points to one specific technical level. He says Bitcoin has a, quote, date with destiny at the 200-week moving average.
Right.
Which is currently sitting right around $62,000.
Yes, it is.
But why does that specific line matter so much? I mean, is it just a self-fulfilling prophecy because algorithmic trading bots are programmed to execute buy orders at that exact price? Or is there an underlying logic to that moving average?
Oh, it is much more than just an algorithm. The 200-week moving average represents roughly 4 years of price history. Mechanically, it acts as the psychological baseline of the entire market. It represents the average cost basis of the long-term foundational holders.
Ah, yes.
Yeah. And in every single major bear market cycle for Bitcoin, that specific average has acted like a gravitational magnet. It eventually pulls the price down to wash out the short-term speculators and really test the absolute conviction of the core buyers.
Right.
Historically, it marks the ultimate cyclical bottom.
And what is genuinely eerie here is how closely this current 2026 cycle is mirroring the 2018 cycle.
It's almost identical.
The technical footprints really are. In 2018, the market established a local low in February, rallied to a lower high in May, and then broke down toward a deep June low.
Yep.
Fast forward to today, we hit a low in February at roughly 60,000. We rallied to a lower high this past May, and now here we are in June, sliding down toward that $62,000 mark.
And the structural duration of the market movements aligns perfectly as well. Well, the market just completed a 17-week rally without setting a new low. If you look at the historical data from the major downturns in both 2018 and 2022, these specific pre-flush rallies typically exhaust themselves between 20 and 21 weeks.
Interesting.
So structurally speaking, a breakdown happening right now is operating entirely within the normal, predictable parameters of the asset.
I mean, I look at this and I am just amazed. We have spot ETFs trading on Wall Street now.
Yeah.
We have an AI economic boom totally reshaping global productivity. We have former national security officials lobbying Congress.
All these massive variables.
Right. And despite all of that, Bitcoin is essentially executing the exact same technical dance it did in 2018, just at 10 times the price.
It really highlights the raw mechanical power of market cycles. Because you're right, the macroeconomic backdrop is entirely different today than it was in 2018.
Completely right.
The players are institutional rather than retail. The scale is in the trillions rather than the billions. Yet the structural sequence remains intact.
So what's the actual path forward then?
Based on Cowen's historical mapping, the predicted path involves a significant June low, potentially wicking violently below that $62,000 average to trigger stop losses and sweep out the late buyers.
A total washout.
Exactly. And that capitulation would be followed by a sharp relief bounce in July, leading into a final exhausting cyclical drop in the fourth quarter.
Wow. Well, we have covered a massive amount of ground for you today.
We really have.
We mapped out the 5 forces, from the institutional ETF outflows to the mechanical avalanche of forced liquidations that basically drove Bitcoin down to 65,000.
Right.
We explored how a trillion-dollar tech boom and unprecedented government deficits are acting as this massive multiplier, absorbing capital and keeping the U.S. economy running.
And we also detailed the hidden mechanical risks threatening that expansion, The Federal Reserve's attempt to manage optics by swapping inflation metrics and the rapidly depleting strategic oil reserve.
Yeah, that ticking clock.
We examine the contrasting environments, too. The regulatory gridlock in Washington versus the relentless buildout of tokenized institutional infrastructure on Wall Street.
Right.
And ultimately, we grounded all of this in the undeniable gravity of market cycles, with Bitcoin inevitably being drawn back to test its long-term psychological baseline at the 200-week moving average.
And, understanding the mechanics of these cross currents is just so vital for you. Because when you know why the Treasury is draining oil reserves or how tokenization actually upgrades institutional capital flows, you stop reacting emotionally to red numbers on a screen.
Exactly.
You gain a structural view of where global capital is actually moving.
Recognizing the underlying engines driving the market protects you from being blindsided by single-day narratives. It allows you to anticipate the structural shifts rather than just constantly reacting to the symptoms.
Which leaves us with one final unresolved puzzle to chew on before we get.
Oh, this is the big one.
Yeah. Benjamin Cowen's cycle analysis, which again is built on years of resilient historical data, predicts a major relief bounce for the crypto market in July after this current flush.
Right, the July bounce.
But as we unpack today, the hard macroeconomic data shows that the United States and China will deplete their emergency oil reserves in late July.
Setting up a collision.
Exactly. That depletion threatens to trigger a sudden, massive inflation shock and force unexpected interest rate hikes, which historically crushes risk assets.
Yeah.
So what happens when those two immovable forces collide? When the seemingly unstoppable historical crypto cycle meets a brutal, undeniable macroeconomic reality in the exact same month, will the macro reality finally break the crypto cycle?
It is the defining financial question of the summer.
It really is. Well, thank you so much for joining us for this deep dive into the source material.
Yes, thanks for listening.
Keep analyzing the mechanics, keep looking past the headlines, and we will catch you next time.